paper for a while. We approached this paper from different angles, and we could not really exactly figure out all the things that we wanted to do in this paper. But let me just jump in and first try to define the VIX that most people know, but let me just put it up. So the VIX captures the conditional expectation of a convex function, and this convex function is right given over here. Oops, I don't know what happened. So essentially, the VIX, captures, volatility in the underlying equity index. And this is a scale payoff. The log function, the minus of the log function is like entropy. So it's like volatility. And it's very important that it be multiplied by 2 over h, which is going to give you, units in annualized terms. And h over here is just the forward futures price. And the VIX itself is not traded. I mean, just like interest rates are not traded, VIX by itself is not traded. There's only one VIX, which is the current VIX. You don't have VIX over different maturities or different periods. And the way that CBOE, circumvented this dependence on this information set IT is by approximating the VIX through a portfolio of traded put and calls. We know what that positioning looks like, and that's just based on the log contract. You can span it, and you can get the price. You can get the value of the VIX. Now, what we are doing is, and also note that H over here is the next 30 days. Okay, so it's very, very important to keep in mind that the pockets of uncertainty that we'll be dealing with will be fixed at 30 days. So now let's look at the futures contract. So the futures contract is the conditional expectation of the VIX at some future date, say 6 months from now or 4 months from now. We don't know what the value of the VIX is at the future date. It's a random variable. It is dependent on an option positioning. We don't typically know what would be the weights in those in the positioning that goes into the VIX. So, and also VIX is not storable, so it's a random variable. And so it's important to understand that there are two different kinds of information set, that you'll have VIX at time t, and it's going to be based on this information at time big T, and then you're taking a conditional expectation based on current information. So that's what really makes this this problem very intractable, in the sense that you have a square root of the VIX. I mean, it's a number, and you're taking the square root of the VIX squared. And typically it will not have a closed form solution because of the square root. Yes, people have taken some approximations, but if you have a large number of state variables, then you're not going to be able to write it down, because you're taking the conditional expectation of the square root. Even if you take approximations, even if you do some things that people have been doing, and then even if you do, even if you can approximate it, you still have parameterization. So you cannot really show it under all parameterizations. So the question is, how can you think about a way in which you can try to think about rationalizing the slope of the VIX futures curve? So that's the problem, essentially. Now, just to make sure that we are on the same page, this is the kind of pockets of uncertainty we are talking about when we're dealing with two different futures contracts, and the H is fixed at 30 days. So what we will basically try to argue is that the long dated pocket of uncertainty is larger compared to the pocket of uncertainty in the short run. So essentially, you know less about this uncertainty, which is farther dated. So its price under the Q measure is going to be larger. Okay, so it's a kind of stochastic ordering that we'll be dealing with, and it's kind of related to the notion of stochastic dominance, but in the other direction, in the sense that, first of all, VIX uncertainty is not really a payoff. It's some traded, it's some non-traded uncertainty, and also we are dealing with larger variance. So it's like the opposite of what you would think in terms of the notion of stochastic dominance. So essentially, what we will say is that the short-dated uncertainty is smaller over this earlier pocket as compared to the longer dated pocket of uncertainty. So the futures curve is going to be in contango, which is upward sloping. Basically, that's, and then we're going to use workhorse models to actually operationalize that idea and show under what intuitive conditions this will hold. So that's essentially the paper. Okay, so let me just move ahead and just try to give you some stylized facts, but here is a typical VIX futures curve. During normal times or good times, it's going to be in contango. When you have bad times, like in the crisis of 2008, it was in backwardation. So what is the interpretation? I mean, the interpretation is that there is too much uncertainty right now, and very likely VIX is mean reverting, and this uncertainty is going to persist for a while. And when this log jam of this bad uncertainty goes away, then it's going to revert back to contango. Okay, so that's the way that we're going to show some of the ideas or in this paper. But this is a typical pattern that you see, during bad times versus good times. Okay, so what are the stylized facts? Some of you may know these stylized facts, but let me just very quickly go through the data. We have almost 14 years of data daily, and we have matching data on VIX options, which we have used in the internet appendix, some exercises that we're doing. We have matching data on the S&P 500 index options. Now, we also have data on the VStock futures, and these are the European indexes, and I will also try to present some data on that. And much of the stuff is in the internet appendix, but I'll try to highlight some of the similarities between the two markets. So some of the things that we're going to be saying will be applicable to the futures on the VStock index, which is the counterpart to the VIX on the Stock 50 index, on the Stock 50 equity index. All right, so the first stylized finding is that VIX is in contango 82% of the time, whereas the futures on the VStock are in contango 76% of the time. But the sample periods are not exactly the same, because the VStock started a little bit later compared to the VIX, but they are quite similar. We have not checked whether it's also 76% for the VIX over the same sample period. We will, but you can see that approximately 82% of the time, the VIX futures are going to be in contango. We have the distribution, whether you're looking at the short dated or you're looking at the long dated. We also have all the open interest and volume in the internet appendix, which I'm not going to show you, but much of the volume and open interest is actually concentrated in the first 3 months. And I have omitted large number of numbers over here. So I'm only providing you a snapshot of the data. So this is one stylized fact based on this particular market. Now you can also run a regression on a daily basis, whether you have 6 contracts or 8 contracts. You basically get the average slope on a daily basis by looking at this particular regression. And you will find that the slope coefficient is significant on 2,702 days out of 347 days that we have in a sample. So 70% of the time it's in contango. whereas it's negative and significant on 16% of the days. So it's basically mapping up. If you look at the daily data, how many days do you have contango and how many days do you have backwardation? And the 16% of the days will be typically associated with bad days in the market when the VIX is high or the S&P 500 has had a negative return on that particular day.
So let me jump in with a question from Steve Heston. So the question is, how do you impose intertemporal consistency to prevent buying long-term options cheap and selling them?
You mean well, there's no notion of cheapness or expensiveness over here. You are just in doing it from the futures market. I mean, in VIX is not tradable. All right.
Well, I don't actually completely understand Steve's question, so I'll invite him to either unmute himself and jump in now, or else unmute, or else clarify it at the end of the talk, whatever he wants to do.
Okay, I talk to Steve all the time, so I'll talk to him later.
All right.
So, but yeah, it's a good question, but the VIX is not tradable. So, but anyway, I will get to that in later on if I have more more comments on that. All right. So I also wanted to give you the distribution of the contango and backwardation by bad states of the VIX. So if I mean here this this classification of bad states is essentially high volatility states, and it's somewhat arbitrary that higher than 30 VIX is bad, but I've just clubbed them together for now. You can see that when VIX is very, very high, then you find that the slope is positive only 1.8% of the time. And of course, it is monotonically increasing as you go from high VIX states to low VIX states, which means that when you have low VIX states, which is calm periods, the state of the VIX futures curve is almost always in contango. So during good times when you are low in VIX volatility, then the VIX futures curve is in contango. I don't want to spend too much time on it because I'm just trying to give an idea of the stylized facts in this market in a few slides so that I can talk to you guys about the theory and take some questions over there. Now let's look at the bad states versus good states. So what we found somewhat surprising is that even in some good states, you can find backwardation. And that is an important point for a theory, because if you have multiple state variables in your theory, then there will be some interaction between the multiple state variables where there will be some, where there'll be some conditions under which it is possible. Okay, but during the bad states of the S&P 500, which is when the S&P 500 went down by more than 2.5% on any given single day, then you can see that the VIX futures are going to be in backwardation. Okay, so I'm just trying to present what the data is telling me. There may be other ways of actually slicing and dicing the data, but we found that these two are in ways are natural ways to show what is the distribution of contango or backwardation of the VIX futures. All right, so let me also make one simple point, that the VIX futures curve does not move in tandem with the slope of the ATM options on the S&P 500. As you can see from here, that 36% of the time, and the VIX futures curve is going to be of the opposite direction to the slope of the S&P 500 ATM options curve. So what's that telling you? That that the VIX futures curve has some independent variation of its own, compared to that from the index option market. How relevant is this fact? It's kind of debatable at the moment, But all this is saying is that you have a factor structure of the VIX futures, and they may or may not share the same factor structure as that in the ATM walls in the S&P 500. Okay. Now, finally, we will show that daily VIX is mean reverting, and this is just based on one second. This is just based on the Hirsch index. And if you have a value which is lower than 0.5, I mean, it may not come as a surprise that the VIX is mean reverting, but we had to do a test because it kind of feeds into some of the theory that we're going to be showing you later on, that we will be modeling volatility as a mean reverting process. So it's important to see and check in the daily data, whether the VIX is mean reverting. Okay. Finally, we looked at how many principal components do you have. If you have 6 futures contracts, then the 2 principal components will let you describe much of the variation in these contracts. So one is just the average factor, and the second one is just the negative of the slope factor, because the long dated futures contracts are loading negatively, whereas the short term ones are loading positively. So it's the negative of the slope of the futures curve. Okay, and this is going to feed into how many factors you want to build into your system for the volatility uncertainty. Yes, you can go to 3, you can go to 4, you can go to 5, but we will show you that 2 will, yes, I mean, you have the flexibility to build as many factors as you want, but I think 2 would be sufficient. You want to be at least 2. Okay. All right. So the VIX, I mean, we felt like that the VIX futures or the Contango was very poorly understood. We checked many different blogs. We looked at many papers, and many of the practitioners that that we looked at blogs and papers. I mean, there was not a very good explanation for why VIX in futures are in Contango. If you're trying to build models based on consumption and other things, I mean, it would be harder to go through that route. But yes, I mean, those are interesting toy models. So we wanted to do it in a slightly different way and build up a slightly different theory, which hopefully I can convince you is the right one to understand the VIX futures, Contango. But the whole point is that pockets of uncertainty on which the VIX futures depend in the long term, in like long dated ones, they will be valued more as opposed to the short dated ones. So which is going to feed into this notion of the stochastic orders, that the short dated volatility pockets are smaller compared to the long dated pockets, and that's what we will be focusing on shortly.
Can I ask, John, I'll ask my own question. Let me ask a question about the previous slide. So the first principal component, the factor loadings on the first principal component are all basically the same.
Yeah, that's the average factor, yeah.
So the first principal component is interpreted as parallel shift in the VIX futures curve. And so all of the changes from Contango to backwardation are due to the second principal component?
Let's see. So what do I mean by, so the slope, you'll have to take the first difference, is that right? So no, the first, yes, so you have to build up the time series of 2 minus 1, 3 minus 1, 4 minus 1, 5 minus 1. And then I think that I was not thinking the way that you were saying. So I don't think I have a good answer to your question at the moment, whether it's due to the, I mean, both. Okay, so let me try to think over here. So suppose if you write down the VIX, okay, that will be linear in say 2 factors. Okay. And then you take the futures contract, and that's a conditional expectation of the square root of the factors. Okay. Now the thing is that it's you cannot. I mean I have to picture this in my head, but it's not like bond pricing, where you write down the log of the bond price in terms of the factors. Over here you have a square root, so you cannot. It's not really invertible. I think that's what you are really thinking. Is that what you were thinking, Neil? Is there
Well,
an
no,
invertibility?
I'm just thinking, let's suppose there's a shock to the first principal component where all the other PCs are just, there's no shock,
I
right?
see. So
Then the VIX, so this tells me mechanically that there's a parallel movement in the VIX futures curve.
I see.
So all the changes in a slope are due to PC2.
That's right. Okay, so now I understand, because each of the futures curve is loading the same.
Yes.
So that's the reason. Yes. Okay.
So then, so that's just the foundation for what's my real question. So PC2 looks not very important. So is this really a big deal? Is the switches from backwardation to contango?
I don't know an answer to your question at the moment. I mean, when we go to the theory, then we can revisit this particular issue.
Okay.
But I think there is what I was trying to go back analytically to answer your question, that if I can map back the futures curve in terms of the state variable, like what we do in term structure literature, but that mapping is not really possible. It's not invertible. So it's not spanned. I think that's what I was trying to think in my head. That the two factors.
I should stop wasting your time and let you move on.
Okay. So this is just a summary of the things that we just talked about. So I'm going to move on and then try to give you the theory and then take some questions from there. Okay. So why is it a puzzle? I mean, just one sentence. I mean, S&P 500 is mostly in contango. Wicks is a hedging asset, or Wicks Futures is a hedging asset. It's also in contango. Stock and the wall, they're negatively correlated, and so this is why people have not been able to figure out why the Wicks Futures are in contango, or there's no explanation that I'm aware in the mainstream finance journals. Yes, there may be papers that I've looked at, but our explanation is a little bit different. All right. So again, the theory is basically asking the following question: when is the short-dated VIX futures less than or greater than the long-dated futures contract, where the futures contract is defined as what we have over here. It's a complicated looking object, and this is a complicated looking object because it also depends on the price of options at some future dates, because you are backing out the VIX based on the options data. All right. There is no exact closed form solution to a knowledge, and even then you would need parameterizations and you will have to estimate the model. In some of the stuff that we are doing, you don't really have to estimate it, because you will see it will pop out in a certain way, which will match some of the features of the data. All right, so we are going to define the VIX squared. So Z tilde T1 is basically VIX squared, but say 3 months from now, or 2 months from now, or 1 month from now. And again, it's H is 30 days, and these two will, and then you have to take the conditional expectation of ZT1 and ZT2 to get the VIX futures price today. In the first, you have to take the square root and then take the conditional expectation as of time now. All right, so this is, again, I just put it over here just to remind you what we're dealing with. I don't have to talk about it, but okay, so here's what we are really saying about the stochastic ordering. So what we're really saying that short-dated uncertainty, which is reflected in Z tilde T1, is going to be stochastically smaller than the long-dated uncertainty, and where the symbol is basically that of stochastic orders. So the intuition over here, just like to think about in terms of stochastic dominance, is that ZT1 is less likely than the ZT2 to take larger values, where the notion of large means any value greater than Z, and this is true for all values. So keep in mind that uncertainty over here is a positive random variable. So it's between 0 to infinity. And this is, but if you're thinking about stochastic dominance, then we are saying that Z to 2 stochastically dominates under the P measure. I mean, that's a P measure concept. Over here, you have a Q measure concept in a way, okay? But we kind of prefer this notion of being stochastically smaller. There are no utility functions over here. There's no P measure over here. This is not a gamble or a payoff. It's like the opposite of that, because you don't like long dated uncertainty in a way. Okay.
So let me interrupt you again. A question from Ingha Chung. So why focus on Contango? Contango can occur due to expected movements. Isn't the key quantity for asset pricing the difference between the futures price and the expectation under P of the VIX?
Yeah, I mean, you could, I mean, that would be the risk premium, but that's very well understood. It will be negative. I mean, we don't have an answer to the Contango part. So yes, we can focus on that. But I think most people have looked at the volatility risk premium. It is negative. I mean, no matter how you. I think I need to formulate this in my head. That what is the underlying payoff that that Ingha is talking about? So let me go here and try to visualize that in my head. So this is the VIX, okay? And this is the, so you need to, it's going to be the other way around, is that right? VIX minus the futures price. That's the object that he's talking about.
Mm-hmm.
Yeah, it's going to be negative. I mean, we don't have a closed form solution for that either, but it would be negative for sure. You can.
Gurdip, if I may,
Yeah.
I think his question is more about the term structure of the animal, right? Because we know that the spot value will be negative, but essentially the term structure of the VIX curve has to be related to the term structure of risk premium, right?
Yeah, but you don't know the VIX 3 months from now. So
No,
that
of course,
also,
but-
yeah. So I mean that that question over here. I mean there are better ways of looking at the volatility risk premium than to go. I mean it's not like you're doing currencies. You know the forward price. You know the current spot price. You take the difference, and that's going to give you currency risk premium. I mean, this is a much more complicated object. Maybe it's interesting. I mean, maybe it is, but I was just going by the blogs or trying to gain an understanding of why it's in Contango in the first place. I mean, S&P 500 is in Contango, but VIX is negatively correlated with S&P 500. Why is it in Contango? I mean, I've talked to many people, and there's no answer. I mean, yes, the other question could be interesting as well, but that's not what we tackle over here. All right, let me move on and just try to say a few other things over here. So this is the so this is the result that we are saying that if the short-dated uncertainty is like stochastically smaller, then its expectation under Q will be smaller. And hence, because square root of Z is a non-decreasing function, the theorem is that that will also be smaller. I mean, the main obstacle over here was taking the expectation of the square root. By doing this way, by going this way, you can show that on average, the FT1 is going to be less than FT2. And that's the object that we are after. And now the question is how interesting it is in the workhorse models that we look at. Whether you're looking at simple models or you're looking at complex models. But over here, you have to go through the formulation of the VIX contract and the futures on the VIX contract. It would be less interesting to just do it on the variance. Yes, you can do it on the variance itself, but the main hurdle is to do it in the square root so that you can get a better grip on what the patterns are. All right, so let me show you two different models. So we know what we want to look at. So what is the implication of this in the workhorse model? That's what we are going to look at. If this is going to be stochastically smaller, VIX is going to be in contango. Under what condition do you get this particular condition over there in the case of workhorse models? So let me give you one workhorse model where you have time varying probability of disasters. This will be a two-factor model of the volatility or the VIX. Okay. It's going to have diffusive volatility, it's going to have lambda, which is essentially disaster probability, mean reverting, and it's got an index price dynamics. You can make it more complicated. You can go to Garch models, you can do other things. I mean, that's all people can work on, and I can also work on them. But I just wanted to see, in the case of workhorse models, what does this condition mean? So you can see that if you work out the math, which is there in the internet appendix or the appendex, then the Z, which is basically capturing the volatility uncertainty, will have a two-factor structure. Now note that Z will be positive by construction because you have expectation of a convex function, which is non-negative. So under all parameterization, your Z is going to be positive. Now it's got two factors in there. One is lambda, one is VT. VT is your diffusive volatility at time T. So here T, big T, is actually, say, 3 months from now. You don't know what that number is, but you can unravel it back by using the Tower law and taking conditional expectation. And also lambda is the disaster probability at some future date. So now what you really have to do is to look at the following condition, which is coming from our result one. If this guy is less than 0, okay, then the futures contract on the VIX is going to be in contango. Now, if you work it out, this conditional expectation and some of this math is known or can be modified, then you can see that this term is positive by the Jensen's inequality. This term is positive, this term is positive, this term is positive. Now, if lambda T is actually greater than its long-term mean and VT is greater than the long-term mean, this term will be positive. Okay, which means that the VIX futures curve is going to be in backwardation. On the other hand, if lambda and VT are less than its long-term mean, which is the normal values, when you have good times, volatility is low, it's not as high. In markets are doing well, so the lambda is low, in which case you're going to find contango because this whole term is going to become negative. Okay, over here you are able to show this without using any estimations, because this is just popping out of this theory. Yes, you can think of that the notion of stochastic orders is a reasonable one in this case, because you don't know what's going to happen 6 months from now over the next 30 days. Okay, yes, you can build models of consumption and other things, but in the case of workhorse models like the ones that we have been working on, I mean, this is a two-factor model of volatility, and these models have been well tested. They are fitting option prices quite well on the S&P 500 index. We are not really using VIX options here at all, because the VIX is a product which is based on the index option. Okay, so we have to model the dynamics of the S&P 500, and this is a reasonable one. But let me just go back over here and just put it up over here again, that the shape of the VIX futures curve will be in contango if the current level of uncertainty as reflected in the lambda and the V, which is your diffusive volatility of the S&P 500, is actually less than its long-term mean. So you can think that V long-term mean is like 20%. So if it's lower than 20%, and also lambda, I mean, what's a good number for lambda? People have asked me. I mean, if you look at some of the papers in the disaster risk literature, I mean, what is the probability of a 10 delta move in the market? It's about 10%. Okay, so if lambda t is less than 10%, then you are lower than the long-term mean. Okay, but there are some combinations over here that where lambda t could be greater than its long-term mean, or VT can be lower and vice versa, in which it will depend on the parameterizations. And that's where you will see some kind of a mixed picture in terms of the frequencies that I showed you earlier. But if it's unilaterally true that lambda is less than the long-term mean conditionally, and VT is conditionally less than the long-term mean, then the VIX futures curve is going to be in contango. And it all goes back to the point that the short dated uncertainty is typically smaller over a pocket. Now, if you have a coronavirus scare and everything goes up, then it's going to shoot back into backwardation. But as those uncertainties dissipate over time, or they go away, or there's good monetary policy coming in, or good news coming in, then it will slowly go back into contango, conditionally. It all depends on some of the critical values of the long-term mean. All right, so let me show you the second model, and then take some questions after that. Now, before I go into the second model, I just want to give you like a caveat that we all use some of the models with one-sided volatility. They're just an approximation in my view, because volatility jumps down and volatility jumps up. If you look at after 2008, I mean, many of these VIX products, they have just trended down because the Fed and other central banks have basically cut off the tails in this market. So volatility keeps on going down, it's jumping down. So essentially jumping down volatility is as important as jumping up volatility. So the kind of models that we deal with, they're only jumping up. And why they're jumping up is because you want to keep the volatility process from going negative. Okay, so that's why you only allow for one-sided jumps, but it's just an approximation. Wanted to show you the data that about 111 moves or higher than 10% on the downside, and there are 274 moves on the upside on a daily basis in the VIX, which basically count for 8% of the data. So if you look at this 6 plus 1.8 and 0.6 and 5.6, so it's kind of asymmetric, but it's almost symmetric. Okay, much of the movements in the VIX are in the neck of the distribution. With that said, let me just give you a more complicated model if you have jumps in volatility. So this is a slight generalization of the Duffy-Pond and Singleton model because they don't have time varying disaster probabilities. But I don't know whether people have been able to work out closed form option solutions for this kind of a process. Maybe they have, but we are not really interested in option pricing over here because typically you run into the problem and not able to solve ODEs, but maybe it's solvable. Okay, but over here we don't need that. Given the formulation of the VIX, the way it is to be done, we will have a closed form solution for the VIX squared in this particular case. So you have index price dynamics, you have your joint pause and jump that both are jumping at the same time, and the XV is the variance jump. I mean, although I call it volatility jump, I mean, this is somewhat confusing sometimes, but most people just call it volatility jump or variance jumps. And then this is the size of the disaster, which is an IID distribution conditional on XV. I don't need the exact distribution over here because I'm going to show you that by Jensen's inequality, I don't need to get exact closed form solution. And variance is the same thing as what Steve has been, Steve's famous paper has been doing, but it just has another jump term, tagged on to, which is an additive jump. Okay, so in this particular model, the jumps in the stock or the index and volatility or variance can be correlated. So with this said, I did not show you all the things, but you can derive this exact closed form solution for expected value of ZT1 minus ZT2. Now it turns out that empirically, this expectation of XV is actually much, much smaller because it's a variance jump. It's much smaller than the jump in price. So what we are finding is that price jumps dominate variance jumps in this particular setting. So it means that variance jumps may be important for option pricing, but for the VIX futures curve, the price jump is of first order importance. What that means is that some of the same intuition that we had before. So this term is a constant, which is negative. This term is also negative, and the third term is positive on the lambda, but it's multiplied by this mean jump in the variance, which makes it very, very small. And this term is also positive. Again, it's multiplied. Again, this term is actually positive, but it's multiplied by lambda t minus this. So it turns out that under a large number of scenarios, this term at the top will be negative, which means that VIX futures are going to be in contango even if you have variant jumps. Even if you prop up this volatility through the jumps and you make the distribution of jump uncertainty much more volatile through the jump, even then the VIX is going to be, futures are going to be in contango most of the time. And all these terms are actually time varying. This one, this one, and so on. So this is the only term which is volatility driven. There are two terms on the lambda, and this is more complicated than the previous solution because you now have volatility jump. Yes, some of these structure of uncertainty can be generalized. Many people like to work with Garch models. Maybe people can look at Garch models and see what will happen if you follow the same structure. Maybe over there you can also get closed form solutions given the moment generating function is there. But that's the key point that we're trying to make in this paper is basically from here. Which is that if the short-dated volatility uncertainty is smaller, which people think, you don't know the devil from 6 months from now, but but you may know the devil, which is in the short run, but you can get surprises. So I mean, surprises do happen, in which case the lambda and the VT will go up, and the curve will slip into backwardation. Yes, you can also try to understand risk premiums from here. I need to think a little bit more. What is the value of looking at risk premium through the VIX futures market, or the term structure of the VIX futures risk premium? Yes, it's possible, but I think we are dealing with a non-traded asset over here, which is VIX. But I will have to write it down to see what it is and how we can solve that particular problem. It is indeed an interesting problem. Okay, but I'm trying to think about any other analogy in my head, which can help me figure out if this problem can be answered in a straightforward way. But I cannot think in my head right now. But anyway, so let me go back and conclude. I mean, our paper is just trying to answer the question, why are VIX futures in Contango? We found this problem to be very, very difficult. Maybe other people may find it easy, or they may have a different solution to this problem. But we thought that this problem is non-trivial. And when we looked in the blogs, I mean, characterizing the data was not that difficult. I mean, it's only 3 pages in the paper, just what the data features are. And I think many people already know the data, but coming up with an explanation and formalizing it is where I think much more work can be done and understood. Of course, the next step is the risk premiums, maybe, but we finance worked on the slope of the term structure for 50 years. Then we got into other things, but maybe people can try to work on this for a few years, and then or maybe simultaneously work on the risk premiums. I mean, they're all interesting things to look at, and I'll take any questions.
So at this point, we'd like to invite well, there are some questions that I didn't ask during your talk, so I'll ask them now, or I'll read them from the chat now. But also at this point, I'd like to invite anyone who has a question should feel free to unmute yourself and ask your question using your microphone. But while people are thinking about that, I'll read a few questions from the chat, kind of in reverse order. So sort of a big picture question from Inghua Chung. Does the model fit the stylized fact that average returns to short-dated VIX futures are more negative than average returns to long-dated VIX futures? If anything, more so during contango periods?
Yeah, we did not look at it. We don't know. I mean, maybe it is true. Yes, I mean, you can use a fully collateralized position to look at that particular fact of the data, but we did not look at returns at all. We're only under Q over here.
Okay. So when you say you didn't look at it, you didn't look at that feature of the model, right? It's not you're saying you didn't look at the data.
We did not even look at the data. I mean, I need to first go check the data, what the returns are, and then go to the model. In the model, I mean, I cannot get a closed form solution for the VIX futures even in this model. I mean, I can get the solution of not the square root. I mean, that's not available. So you'll have to simulate it basically under the P measure. No, I mean, look, the P measure is not even defined over here. Everything is under Q. So you need to write down a stochastic discount factor. You need to write down everything under the P measure, and then you can maybe answer this question. There is no P over here.
Okay, so okay, your answer is you haven't solved the model. You don't have the model under the P measure, so you can't answer the question right now.
No, it cannot.
Okay. Oh God, I'm sorry about what I presume will be a mispronunciation, but a sort of a clarifying question earlier from Janos Futing. So you presented some data on jumps, and I think his question is, do you know that these negative jumps are jumps rather than very rapid decay or mean reversion of volatility after large positive jumps, right? Do you know that these apparent negative jumps are actually innovations, or are they, very rapid mean reversion after positive jumps?
I think what he's talking about is this table.
Yes.
This is just the log changes in the daily VIX. I mean, this is not even VIX futures. I mean, we only did VIX over here just because we had a longer data set. So we have to do VIX futures, returns over here as well. No, we did not make any differentiation. There's no intraday data over here. So anything, it's an innovation in the VIX, basically log innovation. So these are percentage changes. Yeah.
I'll allow myself to jump in again, Gurdip, because I was thinking about the same question when Janos wrote it in the chat. So I think one of the kind of things that is driving all of our kind of reflection about this is we're always going back to those parametric models that we know, right? So you're presenting data here, and the first thing I think Janos and I did is, if you have a very low volatility, typical volatility models have a vol of vol that is proportional to vol. So if you have a low vol, you have a low vol of vol. For vol to go high, you need a jump upwards, right? But if vol is already super high, you have the vol of vol that is very high and can kind of magnify a negative innovation. And you have the mean reversion that also pulls downwards. So for volatility to go down by minus 20%, maybe you don't need that much of a shock. Maybe you just need mean reversion to pull like crazy, a small negative innovation that you boost with a high vol of vol, and we're back to normal, right? So I think that's the question here.
Well, I mean, my answer to this is that this table is not really relevant to what I'm doing in any way, because this is just to say that, look, they can be upside jumps and downside jumps. I'm not using this information anywhere. Yes, I mean, it's a pure characterization of the data with no model in mind. If I take a return on the S&P 500, it's like a return in the S&P 500. I mean, I'm just taking log changes in the VIX. Whether it's due to a model or not a model, I'm not trying to make that statement over here. All I'm saying is that they jumps down and up. I mean, whenever the Fed announces a good positive move, the wall goes down. I mean, that's the kind of notion that I have in mind. Sometimes if there is a big move like Everglade, burning up in flames, I mean, wall will go up. That's all on a daily basis. That's it. I mean, it has no meaning in my setting just to justify that there are jumps that are both up and down. And we have not been able to model two-sided jumps in our profession. I mean, so far, because you will not get closed-form solution. Okay, yes, you can do the log wall, but then it creates more problems in other ways, because it's just not okay. Anyway.
No, it's okay. If you go to the next slide, I think kind of some of us might have had the impression that you were building on the previous slide to incorporate.
No. I mean, that was just I was just trying to justify this model as a caveat, saying that, look, this model is there, but we know that we have counterfactually, this model may be counterfactual in a certain way, but this wall jumps up and down. That's it.
Okay, so I'll continue to abuse my position until someone kind of interrupts me. Did you go even more counterfactual? What happens if you have zero jumps anywhere? Just, stochastic volatility, maybe with two components.
Well, that would be fine as well. I mean, so essentially you are saying that give me another latent variable wall. So you have a two-factor structure, but the intensity is constant. That's right. Is that what you're saying?
Not even intensity, zero intensity, no jumps.
Yeah. I mean, so then you have a two-factor model. I mean, that model will also be able to fit some of the stuff. I think that the math over here will be a little bit different, but you will get something like that.
Yeah, so the reason why I'm asking is that the condition that you found at the bottom of the slide involves both the jumps and the volatility.
No,
But
no, no. It can be any other state variable. I mean, you can derive that. I did not derive that model. You can have a two-factor model of volatility with like two variables, like in David Bates' paper. You can have V1, V2, square root of V2, and then you can work through it. You would still not have a closed form solution if it's latent variable, but these coefficients over here would be very, very similar. You'll have another coefficient. This is more complex, but you'll have another variable over here. It's going to be basically parallel structure as that. Short dated volatility, long dated volatility. I mean, if you want to call it that way. I mean, maybe similar to one of your papers, short dated long term volatility structure. Yes, you can also do that, but I did not present it.
So then there's a question from Marco Avianeta that may be related. So is it possible that VIX Contango backwardation is related to some form of market segmentation, i.e. short-term demand for portfolio protection versus long-term forward protection?
Yeah, could be. I mean, when I talked to Dilip Madan about these things, he says that when he was Morgan Stanley, the VIX people did not talk to the index option people and vice versa. There may be some segmentation. I mean, over here, my job was to write down a framework which we can use to understand this particular phenomenon. And that's, yes, there may be other things empirically possible or theoretically possible, but how to model all of these imperfections in models that we deal with, I don't know. Maybe that is possible.
Anyway, I encourage anyone who wants to ask a question, don't be shy. Feel free to unmute yourself and jump in. It's your opportunity to tell Gurdip he's wrong, whatever you want to say.
Okay, I've got a question that falls in that category. Not telling him he's wrong, but any stupid thing. Have you done anything to try to empirically track the parameters lambda t and vt? And do you think that there's any hope for looking for economic modeling for things that would move them above and below the long-term averages?
Well, I did not do it that way, but a nice way of thinking about lambda would be just to look at deep out of money puts. I mean, that's the probability that I'm looking at, and basically fix the delta and compute those returns and compute those probabilities. I mean, that's just so the lambda t is just the price of a binary, all right? I mean, I can get the time series of that if I want, but I did not do it.
Okay, I think that would be valued. I think that especially by the finance community. Yeah.
Yes. So we can get that. I mean, so the whole point of the paper was not to get into this heavy duty estimation. Yes, I mean, yes, we can do that. But so you can think that lambda t and VT are actually latent variables. How will you get the time series? You have to fit it to index option prices, do a Kalman filter or something else, and do other kinds of estimations, and then basically look at the time series, compute this condition on a daily basis, check if it holds, versus Contango, versus whether the VIX futures are in Contango. There may be other ways of using VIX options that we have been exploring, but we thought that would take this paper too far away than what we want to do over here. So we have some ways of thinking about using VIX options, because it's essentially future uncertainty. You can think in that way, in a model-free manner, perhaps.
Hi, Gurdip. Steve Figlewski here.
Hi, Steve.
I enjoyed your paper. I enjoyed any kind of work in this area. I think there's an awful lot of stuff we don't understand yet. One thing that is perfectly obvious to anybody who looks at index options doesn't really get directly into the VIX. It's in there, but it's kind of hidden, and that's the volatility smile. Now, the smile is got to be in the VIX, but it's not a monotonic connection. Your models will generate a smile, and my question is, have you checked, to what extent have you checked that the smiles that come out of the models you're fitting actually match the smiles that we see in the marketplace? And if they don't, there's got to be something going on in there that hasn't yet been modeled.
Well, I mean, the model over here is heavily parameterized. Yes, we can do it. But I think a simpler way of doing it is to look at the smile, like you were saying, essentially run a regression of deep out of money. I just run a regression of implied walls on the moneyness, get the slope of the curve, and see how does the slope of the S&P 500 curve, how does that move, relative to the VIX futures contract. I mean, that may be another way of characterizing the data.
That's it. You're looking at the variations in the term structure. At the same time, there's variations in the slope for each given term.
Yes.
And the variations in that are hiding somewhere, but it's not clear where and how we could make use of that information in fitting the models like the ones you're doing.
Yeah, I mean, yes, you can. You'll need index options on 1 month, 2 month, 3 months, 4 months, 5 months, 6 months. Get those slopes on a daily basis. Look at the changes and then connect it. But I think that yes, that we can do it. But it's a way to understand what causes the variation in the slope of the VIX. I mean, we did some exercises which are in the internet appendix, which I don't have it over here, but they're in the paper, which is that we try to predict the slope of the VIX futures curve. So if you look in the appendix of this paper, there is a big exercise over there. But we thought that, maybe it's just getting too boring to actually look at, what really explains the variation in this Contango feature. So we looked at large number of state variables, both the one-factor models and the two-factor models over there. It's there, but it's not there in my presentation.
Mm-hmm.
And one of the things that you're really talking about is basically jump structure, ATM walls, risk reversals, and things like that in both the VIX market as well as the S&P 500 index option market. So it's there.
Yeah.
Okay.
Other questions? Last chance.
Okay, so if everybody is too shy to.
Marco Villanito has a question.
Oh, Marco.
Oh, sorry. Go ahead, please.
Yeah, this is just the idea that that the slope of the VIX could be also identified with the term structure, could be somehow anticipated, could be looked at the market. If the market traded constant maturity ETFs on VIX, for example, like DXX, and they do, but only for the first two expirations, then you would have sort of a monetization of the futures roll, rolling from one expiration to the next. And so maybe I was often thinking that maybe the slope is related to some anticipation of a rolling or of information that might affect the forward slope. So that's kind of tautologically, right? The futures indicates not only an expectation of VIX on the risk neutral measure, but also of the changes in the roll, cost of rolling in the risk neutral measure. So the slope of the futures is the cost of rolling in a way.
I think that's an interesting point. I think we have a small discussion in the conclusion that the slope that this VIX Contango also affects products on volatility. I mean, this kind of similar phenomenon, or it's kind of related phenomenon that you can use to understand some of the behavior, but we did not go in that direction yet.
Right. It's. I was referring to potential, VXX, VXZ type products, except that they're usually done for a
Yeah.
one roll.
That's right. That's right.
The difference between spot VIX and first VIX future, or between the first VIX future and the second VIX future, you have a VXX connection there.
Yeah, I mean, it's unstable, but there. I mean, people complain about
It is unstable. It is an unstable situation, since most of the action involves some sort of backwardation, right?
That's right.
How do you go from contango to backwardation? And so that there is a demand on VIX products, but also, relative to the immediate, to the back of the curve. Yes. And
I mean,
that-
these are all, yeah, go ahead. Yeah, these are all interesting problems to look at. I mean, we found it very challenging to look at this problem.
Yeah.
Yes. Well, thank you for having me here, here today, and to be able to give this talk. I really appreciate the ability to be here. Thank you.
Well, we really